So today I'm going to talk about, I think when the invitation went out, it said that I was going to talk about GST. That's one of 4 topics that I'll be talking about today. I'll just be going over various types of compliance issues, namely the GST, the Voluntary Disclosure Program, Taxpayer Relief, and just some current CRA audit trends. So first, I'm sure most of you guys are very familiar with the GST or have at least a basic understanding of it. I know some of you guys have seen me present on GST before. It's not that complicated. This is a very basic GST topic. So just a quick primer on GST. As many of you know, if you are selling taxable supplies of products and services, you have to collect GST, report that on your GST return, and remit that to the CRA. And at the same time, if you've paid GST on expenditures, you can actually claim that back as input tax credits on your GST return, and the net effect is what you effectively pay to the CRA. And if your input tax credits exceed your GST collected, well, then you get a refund from the CRA. So that's a really basic understanding of how GST works. So what we wanted to talk about today was the closely related corporations election that's available to taxpayers. So this is not really a new election, but just the mechanism of how it gets processed has changed. So if you think of 2 corporations that are doing business in the same related group, so you have Company A that's maybe renting its building to Company B for use in Company B's operations. Company A would normally collect GST on those rents. So Company B would pay the GST to Company A would remit that to the CRA, and Company B would presumably get input tax credits to reclaim the GST that it paid to Company A. So when you step back and think of it from a CRA's point of view, they're not really better or worse off in that type of transaction. It's really a wash transaction to them. They're not making any revenue off of it. So what happened years ago is people said, well, is there a way in a related group we can just simply avoid the GST altogether on these intercompany transactions? It's just an administrative burden and it's a cash flow issue for us to deal with. So they basically implemented this election, and in certain situations you can elect to treat the transaction to occur as if it was at nil value, so that no GST has to actually be exchanged between the 2 parties. So I wrote there, it's not always ideal to elect. I mean, I would say most of the time it's nice to elect because you get away from the administrative burden of doing it and switching hands on with the cash flow of the GST. If you have a situation where, for example, the Company B in my example that's claiming the ITC is a monthly filer, and you're actually getting the refunds quicker than the person that's remitting the GST to the CRA, which may be an annual filer, that situation may actually be better to just not elect at all. But just keep that in mind. You can't use it for every single type of intercorporate transaction. If you have a sale of real estate or the property is not exclusively used in commercial activities, you can't actually use this election. So a lot of times our clients always ask, well, what is a closely related corporation? I'll just quickly skip to this example. A closely related corporation, for GST purposes anyways, is generally, and just high level, it's really where one company owns at least 90% of the voting shares and the value of another company. So in this particular example where Mr. A wholly owns Company A and he also owns Company B, these companies are not actually closely related for GST purposes, even though intuitively you would think, oh, well, they're owned by the same guy, the election should work. It actually doesn't work in this particular scenario. And oftentimes, when we talk to clients, they say, oh, I've relied on this election, and we look at their structure and it might be something like this, and you're actually offside in this particular case. So using that example earlier where Company A is leasing its building to Company B, they would still have to continue to charge and collect GST in that particular transaction in this type of structure. In example 2, all we've simply done is interposed a holding company above Company B and C. So now Company A owns 100% of Company B, and it owns at least 90% of Company C. So in this particular case, any transaction between company A, B, and C, or any combination between those three companies will actually be, you can actually avoid the GST. So if there's management fees, if one company is renting a building to another company, or if they just they're selling products to each other, in this situation, if you file the election, you just don't have to worry about GST at all. In this particular example, there's now a family trust that owns company B, but you can see the voting shares and the value shares are actually separated. So company A doesn't actually own all of the value, or at least 90% of the value, in company B, the family trust does. So in this particular situation, again, the election is not available. And this is a very common structure that our clients will have. But if the value shares and the voting rights are separated, this election won't be available. So years ago, when this election was introduced, ironically, there was an election form that needed to be completed, but you actually didn't have to file it with the CRA. You'd simply complete the form, put it in your drawer, and when the CRA asked why GST was not being charged between the two companies, you'd simply show them the GST election form and they'd go away. The rules changed for 2015, and now the CRA actually wants to see the election form filed, and you actually have to file it on time. So the new form is now RC 4616. If you are a business that previously relied on this election, so before 2015 you were already relying on this election, the form has to be filed with the CRA no later than the end of this year, so December 31st, 2015. If you are doing the election the first time this year in 2015, then it needs to be filed by the end of their earliest due date of the two corporations' reporting periods. So you look at the GST returns of both companies, and whichever is due earlier, that's when you have to file it by. So just in closing on the GST topic, I think it's not really to do with the election, but just keep in mind, I think sometimes we take it for granted, or we sometimes forget that GST can actually be a pretty significant tax. I know it's really, at the end of the day, it's 5%, but that 5% can get quite big, especially if you've had millions of dollars in sales and then you forgot, oh crap, I didn't charge GST on all of these sales, and now the CRA is coming after you. So just be mindful all the time of GST in any type of transaction you do. If you already have an ongoing business, you probably already account for GST on your day-to-day operations, but there's going to be things like when you do a transaction, like a reorganization that Annalie and Les were talking about, you always want to be mindful of that. If I sold a business, does GST apply to that? And sometimes it does, and there are special elections that you can do to avoid the GST on the sale of assets. Real estate, like Dave's going to be talking about later, GST, I could do a topic just on GST and real estate alone, and Dave, I'm sure, can speak to that as well. GST with real estate is very difficult to deal with. Think about also who you're selling to. When GST applies with non-residents, a rule of thumb I think a lot of us practitioners rely on is when you are selling to non-residents, like if I'm exporting goods to a US resident or I'm providing services to a US resident, I automatically think, oh, it's zero rated and I don't have to charge GST. That's a good rule of thumb, but there were always exceptions to that rule. Like, for example, if the service relates to real property situated in Canada, that's one of those situations where you actually do have to charge GST, and sometimes people get caught in that particular scenario. The internet business, so with this day and age, with sales occurring online and you're shipping goods from BC to Ontario, just remember that different provinces have different rates. Ontario has the HST. So, for example, if I'm shipping a good to an Ontario customer, there's a good chance that I actually have to charge the HST of 13% in Ontario and not just the 5%. So just be mindful of that. So just switching gears now, I'm going to talk about the Voluntary Disclosure Program, which I'm sure some of you are familiar with. I rely on the Voluntary Disclosure Program a lot for our clients. And just a quick primer, it's a CRA administered program that basically allows taxpayers to come forward and fix any of their old or their previous tax filings when something may have been missed. The most common scenario I can think of is, you had unreported income and you didn't know, for example, that you had to report that on your Canadian tax return, and you file under the Voluntary Disclosure Program and get the penalties waived. So the VDP, which we should call that for short VDP, it allows you to waive or cancel the penalties that would otherwise be assessed. So just keep in mind, any income taxes that are owing for that unreported income, for example, would still need to be paid in full to the CRA. So again, the most common scenarios I would say where the VDP would apply is unreported income. If you have foreign reporting forms, the most common thing, and I'll get to that with the current audit trends section, is a lot of our clients have, for example, overseas bank accounts that they've had for years, and then they never knew that they had to report that income and those asset holdings. So now they're kind of coming back and saying, oops, I didn't file this, what do I do? And the penalties there could be quite significant, especially if for 10 years they haven't been filing, and the penalties could be in the hundreds of thousands of dollars. So the VDP is quite powerful in being able to waive those significant penalties. So with any other type of good program, there's always qualifications or criteria that need to be met. There's really four main criteria that need to be met for the VDP. Number one, it needs to be voluntary. So there can't be any type of enforcement action against the taxpayer. So if you're currently under audit for your T2 return, well, you're kind of out of luck at that point in time. Or if you know there's an impending audit, you'd be offside on that particular criteria. Number two, it needs to be complete. So all of your filings have to be submitted with the VDP submission. Any documents that the CRA requests have to be readily available. So they may say, hey, I want to see your Swiss bank accounts. You have to be able to provide that to support your filings. Number three, it needs to involve the application or the potential application of a penalty, which normally applies if something is late. And number four, which is sometimes difficult to meet, is the filing needs to be at least a year overdue. So, for example, if I forgot to file my personal tax return on April 30th, and now it's May, and I say, shoot, I'm going to rely on the VDP. In that particular case, I'd actually have to wait a year until April 30th, 2016, for example, to qualify under the VDP. So, and for that fourth criterion, only one of the filings have to be at least over a year overdue. So, for example, if you filed 2010 to 2015, that 2015 return could still actually be included in the VDP submission. So again, if the VDP submission is accepted, so if the four criteria are met, the penalties will be waived. In certain circumstances, the interest is also waived at the discretion of the CRA. They're not really open about what rate they'll waive, but it is there. It can be done on a named or no names basis. A named basis, just high level, a named basis is on the initial submission, the identity of the taxpayer is made known to the CRA, and all the filings are basically submitted at the same time on that initial submission. The no names disclosure is actually pretty cool. What you end up doing is you don't disclose the identity of the taxpayer on your first submission. You basically tell the CRA what the fact pattern is. You say, I have 10 years worth of tax returns that didn't report my Swiss bank account income and assets. This is what I'm proposing to file. And it'll give you an idea, and the CRA will usually write you back and say, yes, we agree with this filing position, or we don't agree with you. And it allows you to get at least an idea of what the CRA will do and before you make a decision to come forward and submit everything. If you decide you're not happy, then you don't really have to submit anything. And in addition to that, you actually have a 90-day window to actually get all your ducks in order and submit all of the tax filings to the CRA. So this is really helpful in a situation where you're going to do a voluntary disclosure submission, but it may take you some time to actually submit everything. So using that Swiss bank scenario, they may take 2 months to give you all the documents, and then they'll take your accountants, another month to prepare all the filings. Well, if you got caught during that time and you didn't do a no names disclosure, you'd be offside on that first requirement in that it's not voluntary. So by doing that no names disclosure, you're protected for a 90-day window, which is really quite good. Again, there's always going to be limitations on any of these nice programs that the CRA implements. Number one is, and I can tell you this is the number one reason why the VDP doesn't usually go through, and it's not voluntary. So it can't be used if the CRA brings up the issue. So if you received the letter and they said, hey, you never filed this foreign reporting form, the T1135, well, in that situation, you can't actually file the T1135 under the VDP. The VDP only works for the last 10 years for waiving the penalties. So if you had to file 15 years worth of tax returns, years 11 to 15 wouldn't actually be allowed to get waived under for penalties under the VDP. I would say in our experience, the CRA doesn't usually go more than 10 years anyways, so it's a bit of a moot point, but just keep that in mind. And it can be used for late filed elections. So for example, if you had a Section 85 election that you wanted to file and you were 3 years late, that wouldn't actually qualify under the Voluntary Disclosure Program. So on the next topic, taxpayer relief, this is almost, the Voluntary Disclosure Program is always kind of the first thing I think all of us up here think about. Anytime there's something that hasn't been reported or a filing has been missed, I always think, oh, can I do this under the Voluntary Disclosure Program? And the Taxpayer Relief Program is almost like your last hope. It's usually in a situation where the VDP is you're not eligible for the VDP, or you're just offside completely. You're basically now asking the CRA or just begging them to cancel the interest or the penalties on some filings, or you're asking them to accept late amended or revoked elections. And it also allows individuals to get refunds beyond the normal 3-year period. So, because a lot of our clients will always ask us, oh, I got assessed a penalty for this return. Can we ask the CRA to waive it? We can ask the CRA to waive it under the Taxpayer Relief Program, or what we commonly refer to as fairness. I can tell you without a doubt, it's one of the most difficult things to get done and to get accepted. In my experience, I've only had it go through a handful of times, and I've done it dozens of times. The CRA does give you some guidelines on what situations they will allow it. They basically say it has to be an extraordinary circumstance. So, if there was a natural disaster that tore down your house and all your documents in that particular scenario, and you had to get all your documents from the bank, well, in that situation, they would probably allow it. If there's any actions from the CRA that prevented you from filing on time or creating the interest and penalties, they may accept that as well, and financial hardship as well. They may allow it, but very, very difficult to actually get put through. In addition to that, it is expensive to prepare. You usually have to engage an accountant or a lawyer to prepare it. Most of the time when our clients ask us, I'll usually say it's a shot in the dark. It usually takes the CRA up to about a year to even process it. And again, it's like your last you're just clinging for hope with the Taxpayer Relief Program. So when we do the submission, we're basically telling the CRA all the fact pattern of your particular situation, why the penalties or the interest arose, and they're going to look also at your personal situation, and if you're asking for financial hardship, but you're making tons of dough, it's very difficult for them to actually allow the waiver of the interest and penalties. So use it sparingly for sure. We've been encountering over the last year, definitely number one for me is the TFSA audits. As many of you know, the CRA introduced a large-scale audit of TFSA accounts over the last year, and what they're really targeting are investors that have high growth in their TFSAs. I think from 2009 to 2015, I think you can contribute about $41,000. So, they're looking at anything that has excessive amounts above that. So even one of our clients, I think they were able to balloon their TFSA account to $150,000. They were picked for a TFSA audit in that particular scenario, and the CRA is really trying to attack it or look at are there any unusual transactions in the TFSA. For example, are there any swap transactions? As many of you know, swap transactions were disallowed under the new legislation. Is the TFSA carrying on a business because that could potentially put it offside? And are there any kind of prohibited investments in the TFSA? And when I say prohibited investments, for most people that keep, publicly traded securities in there, for the most part, they're not going to have an issue. But when you start holding private shares in your TFSA, that could potentially put you offside. If you have debt within your TFSA, that could put you offside as well. What's been happening with a lot of our clients is the tax is quite significant. Like if you're found, for example, to be offside in your TFSA, some of the gains in there could be taxed at 100%. And really, what that means is any gains that you got on the sale of those securities within your TFSA actually has to be paid back fully to the CRA. And what I've seen on one of the recent files is the CRA has proposed some settlement offers whereby instead of taxing you at 100%, they'll tax you at the highest marginal rate, which this year I think is 45.8% if you agree to pay the tax now and not pursue the matter any further at appeals. So just keep that in mind if you guys are undergoing a TFSA audit. Come talk to us, or if you're handling it yourself, maybe ask the CRA auditor if you can at least get a better rate. With GST audits, I've been presenting on GST a lot over the last couple of years. In particular, GST audits as it pertains to holding companies. And when I say holding companies, I'm thinking Canadian holding companies that have foreign subsidiaries, and the Canadian holding companies are trying to claim input tax credits. The CRA has really been aggressive in denying those ITC claims. But in February of this year, there was actually a favorable court case for taxpayers that we've been relying on. So I think the CRA will actually start changing their position on this particular matter. And Offshore Compliance Division, which kind of ties in with the Voluntary Disclosure Program. A couple of our clients got these letters from the CRA where the CRA basically told the taxpayer that they were aware that the taxpayer had overseas offshore bank accounts that may not have been reported on their Canadian tax returns, and they basically asked for all the bank statements and all the income reports for those overseas accounts. And so just know that obviously if you get one of those letters going back to the Voluntary Disclosure Program, you're pretty much out of luck at that point in trying to get the penalties waived, because at that point it's not voluntary anymore. So if you know someone, or you yourself have unreported income, or yet that you've missed some tax filings, please speak with one of us about doing perhaps a Voluntary Disclosure Program submission.